Afternoon, everyone. We got about 5 minutes here before we have kickoff. Today, we're going to talk about managing risk here on this event on this shortened holiday week. This Friday, markets will be closed. But we're going to address a very important topic, and we're going to talk about your approach to day trading, swing trading. It's a little bit more focused towards someone that trades, 5 times a month or 3 times a month. But all of the theories that are behind the PowerPoint that I have put together today all focus on how to manage risk and how to stay in the game. So you're going to see a Q&A box. You're going to see a chat box down below. You want to use the Q&A box. I will address any questions. This is a very lively event, so if you have questions during the show, click on that little question mark and type in your Q&A answer or your Q&A question, and I will try to address it during the show. I'll keep an eye on it. The chat box is only for the panelists in general. So I am going to pause here for a little bit, let some people log in, and we'll kick off in about 4 minutes. Thanks for stopping in. Good afternoon, everyone. I see more of you are logging in. I do want to draw your attention down to the bottom of the screen. You see a little Q&A box, and if you would like to participate in my reindeer games today and you have any questions, please do click on the Q&A box and ask them via that portal. The chat box is only for the panelists, but this is an interactive session, and it's going to be a fairly quick session. We're going to talk about managing risk, very important concepts that we're going to talk about today. But if you have any questions during the event, it will be a little bit shorter than normal. I don't have that many slides that are put together, but the concepts are very important, especially if you are a swing trader or if you do trade 3 to 5 times a month. Risk management is a very important concept. All right, we're going to start here in about 60 seconds. Hello, everyone. Welcome to how to grow your account, your trading account. Basically, the seminar is going to touch on risk management. We're going to talk about the psychology of an active option trader. My name is Brian Overby. I'm the senior option strategist at Options Play. The entire event's going to last about a half hour today. If you have any questions, please do use the Q&A box. You can see that little question mark on your screen somewhere. Click on that, and I'll be willing to address any questions that you may have during the event. And lastly, the chat box is only available for the panelists, so don't waste your time with the chat box. So let's get started here. I always like to bring up the fact that if you're going to trade options, you do need to get a copy of the characteristics and risks of standardized options, which is right here. You can receive that. First Trade will send you one if you'd like, or you can just go to the Options Clearing Corporation and get a copy of that. If you're going to trade options, it's important that you receive that document. My goal here is I'm going to empower you to grow your account and become profitable in your trading. And a lot of it is really about your attitude and the way that you want to. If you're a very emotional person, it's very hard to trade on a daily basis or also on a swing trading basis every couple of weeks. Emotions are very important, and my goal is to try to beat it into you how a losing trade isn't the end of the world. And that's what we're going to look at today. So you need to build some confidence, understand how your emotions influence your behaviors, and then build the ability to stick with the plan regardless of the current situation, and stick to your plan and just continue trading. Move forward with your plan. And if you have that plan set up and you can hang with that plan, how important that is. I have another friend of mine that teaches options, and he used to always use this little tagline, and I guess I stole it from him, that I'd almost rather teach option trading to a fifth grader than an adult, mainly because if you tell a fifth grader this is how you should do it, that's how they're going to do it. As opposed to an adult, they'll say, yeah, I know you said that was the right way, but the Fibonacci ran into the Bollinger Band and it hit the moving average, so obviously the stock was going to come back. You kind of chuckle at that a little bit, but yeah, everybody kind of likes to play the hope game more than follow the plan and stick to the plan. All right, so successful traders, not due to any secret strategy or indicator. A lot of times successful traders are really more so based off of the fact that they stick to a plan. They manage their risk accordingly. And, some of my best friends that are traders I would actually say are even better than I am at trading, in that if they take a day off, they know exactly the trades that they would have done, right? They know exactly based off of where the market was at, what happened, and they can go back and say, well, I didn't trade today, but if I would have traded, I would have made this amount of money, or I would have lost this amount of money, because my plan is so fixed that if I would have stuck to it, these are where I would have got in and where I would have got out. That simple. They follow a trading plan consistently. They can regulate emotions, especially during a loss. Some of the best trades I've had many times, a lot of traders say to me, successful traders, that the best thing that the best trade they ever had was taking a loss when they thought that the market was going to come back. In other words, they said, okay, I hit my downside risk. I do think the market's coming back, but I'm still going to get out of this trade. Why? Because my plan says that I should get out of the trade. That's straightforward. So regulating emotions. Now, when I think of this, one of the sports where I think this really plays out, and I do think that most professional golfers, because of this, would be successful traders. Day traders, swing traders, option traders in general. And if you ever see a professional golfer that is on the road to winning a PGA event, and they hit the ball in the water, going for the green, and a lot of times they might show a little bit of emotion. They might go, but they go over to their caddy and say, throw me another ball, put it down and swing it and hit it. Very rarely do you see that one minor flaw hitting the ball in the water instead of hitting it on the green affect their entire day. As a matter of fact, by the time they're to the green, they need that out of their head and they need to move on. And those are the golfers that win tournaments. And it's all, to me, if we hit that ball in the water, we got to get back on the horse again and continue to trade and stick to our plan. That simple. And I think the PGA golfer is the best example of that because of how much they control their emotions when things go wrong. So it's easy to create a plan, and I didn't put the slide together. Our chief strategist Tony Zhang did, but I love the fact that this is damn hard to stick to it. I mean, I totally agree with this. Easy to create a trading plan, damn hard to stick to it. We're human, and we often make counterproductive decisions when placed under stress. Very true. People usually panic in those situations. So the inability to take a loss, and I don't want to beat a dead horse, kind of talked about that a lot already in the first couple of slides. Sometimes taking profits too early. So I got a profit. I want to cha-ching, I want to ring that bell and I want to put a smile on my face. So not waiting for your goal to be reached on the profit side of things and taking it too early. Now, there are other rules that you can put with this. You can say, well, at this day, I'm going to put on a 40-day trade. Option contracts got 40 days to live, and if 20 days go by, I'm going to get out, even if I didn't reach my profit. But that's a plan. That's a part of the plan. But to say that, oh gosh, I'm up 50 cents on the trade, even though I wanted to make $1, I'm just going to ring the bell on that trade, that isn't another way to do it. That's just not a way to look at the trades and take the trades. Now, taking partial profits, that goes right in hand in hand with taking profits early. Losing and adding to a position. Now, in option trading in particular, the double up to catch up doesn't really work. I don't mind it on a stock. NVIDIA is a great example of that. What has happened recently, the stock went down quite a bit, and that turned out to be a buy opportunity, as now the stock is back towards setting new highs, 52-week highs, week in and week out. So with that said, I don't mind that concept. If you're a longer term stock trader, you're dollar cost averaging into the position, double up to catch up. I'm going to cut my cost basis in half. I own 100 shares of the stock I like. I'm going to add another 100 shares. Now, in the options trading world, that doesn't really work because you set up the trade based off of your parameters. And so now you're just going to double up to catch up because you're down on the position and you don't want to admit that you're losing. So a lot of times it's easiest to just exit the trade. There are some things that, and we'll talk about here in the First Trade education section, I guess, of their website. They got a very good website with all the archives of all of the videos that we put together here via Options Play by our host, First Trade. But with that said, if you look at option trading and you have put a position on and that position is down, a lot of times people want to try to double up to catch up, and they put on that, by putting that trade on, they're not sticking to their parameters, and it's more of a panic play. I kind of like the way that this is worded. The stock is up 20% this week. I better get in before it goes up another 20% next week. I kind of like the scenario I think that really applies to me, that I've had happen in my career of investing. You buy a stock, I guess one that would be similar in this day and age would probably be Tesla, because of the volatility, because of everything that's going on in a stock like that. And, you buy the stock at 300 and you turn around and at 600 and you don't get out. And then all of a sudden you say, okay, if it gets to 700, I'm going to get out. Before you know it, the stock's all the way back down and it's trading at 400. And you say, well, okay, if it gets back to 500, I'll get out on the stock. I promise I'll get out. And then the stock all of a sudden turns around and it's trading at 300, where Tesla is at today. And you say to yourself, whew, I sold it. I didn't lose any money. So I have had that happen to myself, and I laugh because I've done that. I've done that psychological baloney in my head because of a stock that I was trading that was very volatile. And when you're swing trading or you're trying to do stuff like that, you need to stick to your plan and you need to trade that plan. Now, I've reached a monthly goal. I'm taking a break. Yeah, I still believe that you should stick in and you should trade, but I'll tell you this, on a daily basis, I'll do this, where if I reach my goal on this one day, but that's part of my trading plan. If I'm trading zero DTE options, I reached a goal today, I'm going to stop trading today. That scenario. All right. So this is a story about finite games and infinite games. And when we think about finite games, you have fixed rules. The end is a certain point. You're going to have winners. You're going to have losers. These type of games are basketball, football, chess. There's one person that is going to win that game at the end of the game. Traders don't really think that way. If you think of a finite game, there's no agreed upon rules. Like, in other words, if I'm trading, the market maker has to lose for me to win. That's not the case. That's not a zero-sum game. The game never ends. You have players and then you have dropouts. So the thought about this and the way to really approach it is to think about, why did I go backwards? Okay, one second. Running a business. I'll leave them both up there. Running a business, right? If you have capital, if you are still bringing in revenue, you can run a business and your business will stay open. You stop bringing in revenue, you're going to close down. If you don't have the ability to get through the bad times, and I'm thinking of a restaurant business, something like that, when you have down months because you put too much money in advertising and it pushes you out of the game, well, that now means that you are a dropout. You're not a winner, you're not a loser, you're out of the game. You're no longer a player in the game. And if you think of poker's always an analogy. I don't like to talk a lot about it, but there are just so many analogies where you can think about a tournament, a Texas Hold'em tournament that you'll see that thousands of people will be in and only one person wins at the end of the game. One of the biggest things is if you get all your chips in and you got them and you say, there's no way that I can lose, I got a great hand, and you take that risk by putting all your chips in as opposed to betting some of the chips. You know, one of the things would be like a pot bet, betting a number of chips that are in the pot, and you lose, you're out. You're done. You're dropped out. You're no longer a player in the game. So a big part of winning those type of tournaments is managing the risk of the trade. What if somebody does have a better hand than you? The only way that if you push all in and they have a better hand, they're going to call, right? You can find out that same type of information by betting more methodically. Same thing in trading. It's the same type of thought. If I still have capital, I can still continue to trade. And the goal is to continue to play. That's straightforward. The goal here is to win the game. Much different attitude if you can approach it as far as trading is concerned. If I'm looking at trading not as I need to win this trade, I need to win this week, as a more methodical outcome of this quarter or this half year or this year. My main goal is to not drop out, to still be in the game and let the math work for you. So how can we set that up? So that's the big question. So first of all, does that make sense? that have you had this concept of, I have to win on this trade, I have to be profitable? If that happens and you take that approach, that's where you have situations where you have a solid gain in a position and you get out too early. Why? Because I have to win. I have to make sure I make money on this, so I sound good at in my neighbor's garage, or at the bonfire talking about my trading. I had a win this week. Even though you got out early and you didn't do what your plan was, I get to say I had a win. And that is not what trading is about at all. As a matter of fact, some of the best traders that I know, I remember once I asked a friend if he wanted to be in Super Traders. It was a book that was coming out, and his attitude was, why would I want to tell anybody what I'm doing? Right? Why? If I'm trading and I'm being very profitable about it, I am going to stick to my rules, which are very boring, by the way, not that exciting to talk about. And why do I want to share those rules with everybody? All right. Professional traders want to take the time to set up the rules, come up with a plan, stick to the plan, and make it an infinite game that they're going to play versus a finite one. So how are we going to do this? Well, the biggest thing, and there's been a lot of math that's been done behind this, and I'm going to just put out all these bullets. And if you have any questions, feel free to put them in the Q&A box. But, well, I don't know. This isn't really a seminar that is set up on questions. It's more so, it's definitely a lecture about just the golden rule of trading. And that's what we see here at the top of the slide. You got to learn how to manage risk, and the max risk of each trade should not exceed 1% to 2% of your portfolio. And if that is the case, if you have a losing streak, you have a good chance of continuing in the game and being in the game and not dropping out, because eventually things will turn your way. And if you don't have capital, you are a dropout. You are no longer a player. You are no longer a trader. Small losses are easier to accept. They're easier to let go. And once again, I go all the way back to a few trades that I've thought of in my mind where I hit my risk parameter. I got out of the trade and the stock got ugly afterwards. Even though I thought it was still a good stock, I stuck to my guns and I got out of the trade. And to me, those are the trades that you should be bragging about, right? I lost this, but I could have lost this. And even though that's not exciting to talk to your friends and family about, those are the trades that are going to make you profitable in the end. Okay. Preventing your account from blowing up, because you're managing your risk. So at Options Play, we always talk about, if you're going to be a active trader, never put in more than 1% to 2% on every trade. And there's been a lot of studies done, and you can read a little bit more about this, and I've done some research on it, but if you go to 3 or 4% as opposed to 1% to 2% on each and every trade, your opportunities to get back if you have a stretch of bad trades, the math just doesn't work. It's really important to stay at that 2% level. And so if I've got a $5,000 account, 2% of the trade, it doesn't matter if you got $1 million account or a $5,000 account, you're going to talk about $100. If you can't find trades for $100 and you can't risk 2% $100 on that trade, guess what? You're probably going to lose the $5,000, right? If you're getting there's no way that I'm going to lose this trade. And once again, you go back into betting. You talk about poker hands, and I have a flush, but I lose to a full house. I'm betting on the Eagles to win the Super Bowl. There's no way that they can lose. They got the best pass rush in the NFL. Those type of attitudes don't work in trading. That simple. All right. So our portfolios that we usually talk about at Options Play are usually $100,000 portfolios. So we're really looking at trades that are going to cost you around $2,000. That's a solid dollar amount that you can trade within that $100,000 of risk capital that you're using. And and we can always find trades. We send out trade alerts and inside the software, and I'm sure a lot of you have already looked at it and used it. And a lot of times you can actually put in that capital allocation and say I have $2,000, and it will help you pick the number of contracts that you can trade on that position. That's straightforward. All right, so this is the column, the highlighted column that you want to pay attention to, and you really don't want to lean towards 5-6%. And here's a big reason why. The next slide. If I'm trading a lot, bad things are going to happen. Good things are going to happen too, but we want to focus on the bad things here. So what's the probability of having 7 losing trades in a row with a 50% win rate? So I get a lot of questions at options play, and they'll say this trade didn't, like, in other words, the software or the trades that you are picking there's a golden book of answers, and you're going to be right 80-90% of the time on these trades. And when you're looking at short-term movements in stock, anything can happen, right? You can even look at companies that announce earnings and have great earnings, and before you know it, the stock goes down. So you predict they're going to have great earnings, and they do, but the stock goes down. Why? Because we're humans. And some people take it as an opportunity to say, this is the best it's going to get. I'm going to sell this at the high. Go back to sporting events. A lot of times they say if you make the cover of Sports Illustrated, your stats are going to go down, because by making the cover, that's already been proven that you're at an all-time high, and it's hard to go higher from that point. And see, these are the things that you have to think about when you're a trader and just process them. But let's talk about flipping a coin. If I flip a coin 7 times, let's say I flip a coin 10 times. Let's flip a coin 10 times. You got a 50-50 chance every single time you'd flip the coin of it being heads. But what are the chances, if you flip it 10 times, that 7 times in a row you're going to come up tails? Very low, less than 1% chance of that happening. But now what happens if you do it 100 times? Then what's the chance of it happening? What if you do it 1,000 times and you flip that coin? What are the chances of getting tails 7 times in a row if you flip that coin 1,000 times? Very high chance, right? So if you think about your trading, and I'm coming in, I'm going to be an option trader, I'm going to leverage my account, I'm going to make lots of money, I'm going to do this, and you trade 100 times over a quarter. Do you think you're going to have, and 50-50, we're not even saying, you just have to be medium at picking stocks or picking trades. A lot of times if you have a 50% win rate and you manage your risk right, you can still be a very profitable option trader. And that's, I guess, the moral to the story when I talk about the software and I talk about setting up the trades and managing your risk and sticking to your risk profile. If you do this and you trade 100 times a quarter or 1,000 times a year, you're going to have a situation where you're going to lose at least seven trades in a row. And this is where the 2% rule comes in. They're saying, and if you read anything about managing risk and books on this topic, is you are going to have a losing streak. If you trade long enough, you're going to have a streak, and you have to be able to stay in the game during that streak. You have to be able to have capital to come back and trade again. And that, by increasing your risk capital and going to 5% of your risk capital, as opposed to a simple 2%, it's not that much more, right? Then when this scenario happens and you have 7 losing trades in a row, you're probably out of the game. The 2% level, you're still in the game. You're still a player. And once again, it's not a win or loss. It's not one independent event. At the end of the quarter, look and see where you're at. At the end of the half year, the 6-month period, see where you're at. That is the way that a trader thinks, as opposed to somebody that is literally gambling using options. Okay. How many trades do you place on a year, and how many trades do you want to place on a year? Because there's also a diminishing return, and this kind of goes back to the one bullet point on the one slide. I don't like that bullet as much, but it just says that I reached a goal, I'm going to get out, and I'm not going to trade anymore. I don't mind that on a zero DTE basis, but overall, no, you want to keep, if you got your plan and the setup happens and it's time to trade, you should take the trade, right? Why? Because things go together. Things go well on that trade, and finding the right setup and getting the right risk reward and putting that trade on, you don't want to miss that opportunity. And so you have to ask yourself, how many times do you plan the trade? And that should be part of your plan. And there might not be as many trades that are going to meet your criteria as an official trade, but you should stay within that range. All right, fair enough. Any questions on that slide? Realize this will happen. Even if you're fairly good at picking stocks where you're getting it right 50% of the time, over a 6-month period, there's a chance that you're going to have 7 or maybe 8 losing trades in a row, and you need to stay in the game. That's where that 2% number comes from. All right. So, and limited education, successful traders are not focused on teaching, and that is also true. So, like if you are day trading and you are swing trading and you are successful mainly because you have the ability to control your emotions and stick to a plan. And it's a very important emotion of traders that has, like, I go back to the PGA professional. This is a I think that out of all of the sporting events that are out there, and well, if you consider chess a sport, that would be right in there too. But the ability to control that emotion when you see something bad happen is so important for that of a trader. Now, easy to learn, difficult to internalize. The concepts aren't hard to understand. You come up with your plan, you stick to your plan, and you realize that bad things are going to happen, and you're going to have to adjust when those bad things happen. You still want to stay in the game. You want to be a long-term player in the game. As long as you have capital, you can still get it back. You can still continue to drive forward and try to build your account. Requires facing uncomfortable situations. Yeah, easy to blame external factors rather than face reflection pain, being uncomfortable. You have to accept that ability to be uncomfortable and get out of that trade. I don't want to get out, but the money says, or the numbers say that I can. My plan says that I can. I need to get out of that trade. All right. So you're just a little bit more on the psychology of things, self-reflection, taking time to go back and look at, what happened last month? Why did I get out of this trade? Try to remember so you don't repeat. Journaling, that helps a lot. If you're going to make this a business, very important to document the trades. As a matter of fact, say, in my own Excel spreadsheet, I'll say I got out because the trade broke through a support level on the downside. Like, I like to know why I exited the trade, and I'd like to go back at the end of the month and look at everything and say, what can I do better? Why did I do this? Was this the right trade? Was this the reason why I got out of this trade? The rationale? Sometimes it's as simple as I hit my stop loss point. I'm out. Position sizing strategy to adjust position sizing depends on trade outcome. Yeah. So like if you're down on your account, you're $10,000 account is now a $9,000 account. You still got to stick to the plan. You still got to apply that 2% rule, right? You don't want to bump up because, oh gosh, I lost $1,000 on my $10,000 account. I want to double up to catch up. No, you still want to stick to your plan. You want to, even if you have less capital, you're still going to apply the 1 to 2% rule. That's straightforward. Mandeline, will there be a demonstration of your options play platform? I can show you. I didn't have a plan to do that, but we can do that. Let's pull it up. If you would like to see that, we got a few more time, and I'll just leave it right here. This will be the last slide, and we'll go and we'll look at the options play platform, and I'll address any questions that you may have. We're right at a half hour right now, so normally I would go 45 minutes, but today the slides that I put together was about a half hour. I hope that this was helpful. I think this is a very, very important step. A lot of people skip the process of thinking of becoming a trader. But here, let me stop sharing my screen and I will pull up the options play platform. All right, so I am going to reshare my screen. And I guess I'll address a couple of questions. Apple has been a very interesting stock, right? A lot of things that are overhanging in the company. And the stock has really just been stuck. It's finally started to move to the upside, but out of the Meg 7 stocks, this is one of the worst performers. You also got Tesla in there that's not doing very well either. But right now, we're finally getting some upside momentum in the underlying stock. There's been some headlines about what they're going to be doing in AI, and it's kind of helped out the stock price a little bit. But if I'm looking to do a trade, and this is the setup of the trade, you can adjust. Well, first of all, you have your risk and investment calculator, right? The amount that I want to risk, I want to risk $2,000. And if I do that, it's going to tell you how many contracts that I want to do this. I want to risk $2,000. And it will apply that to the number of contracts that are inside the trade, right? So in this instance, our midpoint on this trade is $8.16. If we buy 2 contracts on this trade, we're going to stay under our risk parameters, and this is where the 1 to 2% comes in, and it's $1,642, just under the $2,000 threshold. And this is how the platform will help you stick to your goals and stick to your trades. Normally, if we're doing bull call vertical spreads, we're going out about 44 days. You can adjust how many days that you want to do on the trade. If I go in and I think about how do I want to approach this? We got the P&L simulator, risk and investment. If I'm going to place this trade and I want to continue to do these types of setups, what the options play platform will do for you is it looks at buying the most at the money option contract, normally going out about 44 days, because that's just a real good mindset or a real good place to, as far as the time decay curve is concerned, as far as option contracts are concerned. So to me, this is a swing trader, more so than a zero DTE trades. You can change it and you can modify it if you'd like. But the platform is more set up for a swing trader situation. 44 days is a real solid time period to do bull call spreads, even buying long option contracts. So if we go back and we look at the just flat out buying of calls, we're also looking at the August 15th expiration. It's going to keep you under the $2,000 by using that trade, $9.55. If you want to paper trade it, I have a portfolio called Zero DTE. You can set up a different name for it, but I'm going to add that position. And then that position will go into the portfolio. And I think I closed out everything that I had in it. So this portfolio is called Zero DTE portfolio, and it will actually show your cost basis, and it will keep track of your profit and loss on that position. All right, what are some other things? Well, some of the watch lists that we have, we've added a few, and I really like these. Tony came up with these and actually did the math that's behind them. And a lot of these stocks Tony talks about on his Monday event, where he goes through a research report that is based off of the same fundamentals that are done in the overvalued stocks for bearish trades. And so this is a new watch list that has been added. And on the other side, we have undervalued stocks. So these would be stocks that you might think about buying overall based off of the fundamentals of the company going along with the relative strength and everything else that goes along with it. So recently Adobe has popped up and actually I recently did a trade in one of my webinars based off of Adobe. But undervalued stock, kind of been beaten up a little bit. We're down on the very weak. So this is a bearish scenario that's happening right now. Relative strength is weak. We got a 1 month bearish outlook and another bearish outlook, so it's going to lean towards bearish trades. Here is the put vertical. We got it set up for $2,000 is our risk management, so it will keep us under that. It's a $12 midpoint, buying the 380, the just in the money, and selling the 340, staying out 44 days. So how does this apply? If I am doing setups, I'm finding stocks that I like. I want to try to be better than 50-50 ratio, right? If I can be right 60% of the time on the direction of the stock, if I set up the trades right, I can be a profitable swing trader, day trader, and I manage my risk accordingly. I put all three of those things together. I set up the trades the same way. I have the risk parameters. If I'm doing a bull put vertical spread in this situation and I'm risking this $1,212, when I'm doing this, I always would like to get at least a 2-to-1 or a 3-to-1 risk reward. On the upside, if I double, I'm going to get out. On the downside, if I'm down 50%, I'm going to get out. And that is part of the rule. 44 days go away. If I get to day 20 and I'm somewhere in the middle, I get out. That simple. I don't want to be in the last 20 days on this trade. Those are the simple parameters that we've talked about with bull put spreads and debit spreads in general, vertical spreads, something where I'm paying a net debit for. So that would be a bear put spread and that would be a bull call spread. And these are the two trades that we kind of looked at. Let's go and look at undervalued stocks. See if we can find one in here that deck is interesting. Relative strength is one. Devon Energy. Oil is going down, so there's a little bit more behind this. Energy companies are doing well. It's a sector that is strong, and I always like to look at the sectors and see where they're at. But this would be an undervalued stock, trading at a very low PE, has a very high dividend yield, if I remember correctly. 3.4% is the dividend yield. Very solid dividend, very solid company. The only issue here is somewhat liquid, right? So if I'm going to be trading Devon Energy, DVN, the liquidity is an issue. And the platform is highlighting it for you. So I'd be much more apt to just buy 100 shares of stock in this. But let's see where the market is at. Here's our bull call vertical spread. We still got the $2,000 risk parameter here. That was set at 2,000. I don't know what I just did. And if I click trade, in this instance, I would be risking $1,925, and the bid ask isn't bad. So August 15th going out 44 days, and we got a bid of 169 and ask of 175. So somewhat liquid. It is somewhat. It looks like we have a decent market. I wouldn't mind looking at that trade. It's suggesting that we would do 11 contracts. We have, in this instance, we're buying the 32.50 just in the money, selling the 37 in here. Max reward, we're risking. I don't like the risk reward as much on this trade. 1,925, but that could have something to do with the dividend too, because it pays such a large dividend. Does it say here? No, it doesn't look like the dividend is been announced when it's going to be paid. All right, anonymous attendee, and I'll leave it here. If you guys want to put some questions in, we will. We're a little bit over. We'll go another 5 minutes or so. Does 1 to 2% of your portfolio mean that simple covered calls or put strategies are not recommended for a 100K portfolio? Anonymous attendee, yeah. When we're saying 1 to 2%, we're talking about active traders. We're talking about people that do bull call spreads, that do short put spreads, that are trading 5 times a week or 10 times a month if you want to go on a more granular scenario, that on a shorter term basis, you're looking to do a couple of trades, you're looking at 10 trades. That's where the 1 to 2% comes in. If I'm thinking of covered calls, to me, that is not a trader. That is somebody that is investing, that is using calls on their portfolio to enhance their portfolio. So what you're talking about is the wheel strategy. And that is a much different discussion. And I tried to emphasize that at the beginning of the event, that this is talking about people that are trading, I'll say anywhere from 5 to 10 times a month doing more leveraged trades, like the trade right here. You're still talking about $2,000 worth of risk on a $100,000 portfolio. But I don't like the risk reward on this trade. I don't like that as much, but there might not be just a better setup in that scenario. I at least want to be 2 to 1 in this scenario. And that could have something to do with it being such a high dividend paying stock. Diamondback Energy is in here. Another energy stock. Another large dividend. Not liquid at all. All right. Here's Google. I would agree. Recently did a trade alert on Google. Already put the position in and already got out of the trade, but it's showing back up. It's obviously very liquid. We're going to look at going out 44 days, trading $8. Yeah, so here more than 2 to 1 in this risk reward scenario. So 1,664 divided by 836. Yeah, almost 2 to 1 exactly. All right. I appreciate it. You're welcome. Thank you for the nice comments in the Q&A box. I appreciate it. All right. So with that said, thank you so much we had a real solid amount of participation today on a shortened holiday week. So it seems to me that people are committed. This is all about managing your risk and even the psychology. And if you are trading and you're talking about covered call trading and you're talking about using options to enhance your stock portfolio, I still think there's some things that you can take away from this. The fact that you're not always trying to get to win, that I want to stick to my goals and not just say that I didn't lose money on this trade, right? As opposed to I made the maximum on this trade. I stuck to my goals and I got out where I wanted to. That's a big theme that's behind it and everything to do with it. All right, so once again, my name is Brian Overby. I am the Senior Options Strategist at Options Play. Thank First Trade for being our host today and all of the educational events that they've hosted. There's a plethora of information on trading. And I think this is kind of the Rodney Dangerfield, to date myself, of webinars. Managing risk is important. The psychology is important, especially if you're going to try to make it a business and you're going to trade often. All right, with that said, I always like to leave it with, well, I hope all the options that you buy finish in the money and all the options that you sell finish out. We'll see you next time. Thanks for stopping in.